Thanks, Jessica. Okay, it looks like we are recording and live streaming to YouTube when you are ready, Mr. Chairman.
I'm watching my phone. Magic flip at the last minute. And there it is. We'll call the meeting of the Isabella County Finance and Administration Committee to order. Time 10 o'clock. We'll look at approval of the agenda. Does anybody wish to have the agenda changed in any manner? Any suggestions? Then we'll approve the agenda as it stands. We'll call to the public. Nope. Anybody online besides our illustrious chairman?
There is no one online except for our illustrious chairman, Hope, at this time.
All right, we'll move on to the first order of business, and that is consider adopting the revisions to the Isabella County General Administrative Management and Operations Policy number 250, which is the travel policy, and to take effect immediately upon adoption.
So this should look a little familiar to you. I think it was last fall that I brought the travel policy forward, and we basically wanted to delete that one sentence about the Board of Commissioners giving ultimate authority for out-of-state travel or approval for that. And at the time, I hadn't done my homework, and now I think I've got a better proposal for you. Attorney Perrone has agreed that taking the sentence out is within the purview of the board, and still the rest of the policy maintains its integrity. I checked with our contracted director of financial services, CPA Steve Krinovic, to make sure that that didn't have anything to do with the uniform guidance. Remember a couple of years ago when we combined, we used to have an in-state and an out-of-state travel policy. Those were combined a few years ago for efficiency purposes. And one of the big things we wrote into the new policy at the time was a lot of language about the federal uniform guidance and what they required. And so I wanted to check with Mr. Krinovic to make sure taking that sentence out wasn't anything, it wasn't in there due to the uniform guidance, and he agreed that it was not. So I'm happy that both of those things are okay, if you will, in the new policy. So specifically, I'm recommending that the sentence be struck that grants specific authority to approve expenditures related to travel outside the state of Michigan as being the responsibility of the Isabella County Board of Commissioners. It's just basically, I've had two instances of this under my tenure as administrator controller, and it's been difficult to get your travel arrangements secured prior to or after board approval, right? You need to secure those. We come to board after the fact, but that feels like it's against policy. So in my mind, if you're not following policy, either you follow policy or you change policy to your practice to what you're doing. So if we want to, one thing the county attorney did say is you can strike that sentence, but please discuss with the board if they want to distinguish out-of-state travel any more than it already is in the policy. And as I thought on that is when I added basically some examples to the end of the policy in section, find it, I want to say 13 or 14.
13.
Thank you. Yeah, so I added a specific example about out-of-state travel there so that I don't want to lose knowledge ahead of time that people are doing this, right? I don't want anyone to make out-of-state travel arrangements without admin being knowledgeable about the out-of-state travel.
Through you.
And so that's why I specifically put out-of-state travel as an exception in section 13, where it just says the specific approval from the county administrator before commencing the travel. The policy already says if you're going out of state that you have to use the most economical means provided or something like that, that you can't you can't use, say, the personal preference of an employee over the most economical means. So it does distinguish it in that way.
I think I remember I was on staff here at the time when the county board first adopted that. I don't know if it was because of a very tight budget year. But I always had the feeling as a department head is that the county board felt that a lot of the other state travel was frivolous. When I know that sometimes there's some very good programs out there, and if it's a economic issue, I think going through the county administrator is controller is proper only because they control the budget.
Ultimately, you're responsible.
Yeah.
Mhm.
We are
Well, we
ultimately,
are,
but ultimately we come to you for answers. So you've got to have the answers.
So I don't have any issues with these changes.
And every example I've seen of out-of-state travel thus far is to not only for training, but to complete training, right? To get that final course. And I know our animal control officer Marvel had went, and also 911 director Mark Griffiths. So
Okay.
great training opportunities.
And the board shouldn't hinder that. And
Right,
that's what this is
exactly.
all about.
And they're budgeted, right? It's a
Yeah.
budgeted expense.
Yeah, the money should already be there. So, yeah.
Exactly.
I would just think of one example, Great Lakes Park Training Institute, 10 miles in Indiana. Had to always come to the board. And it was a program, it was an excellent program, but it was not available in the state of Michigan through the professional society. But
10 miles does it, huh?
so I'll move that we consider, I'll move that we move the consideration of adopting revisions to Isabella County General Administrative Management and Operations Policy number 250, travel policy, to the work session next week.
I support.
All in favor, signify by saying aye.
Aye.
Aye. Opposed, same sign. Moves forward. Next item, consider adopting the Isabella County fiscal year 2024 budget calendar as presented. Any changes in the sequencing from what we had last year?
Really, is there, Melissa? I mean, we really went through, I mean, we were purposeful about the dates, we checked board of commissioner dates and finance dates and all that, but we really kept the same format as we felt worked well for us last year.
I thought it worked well too, giving more time for review and questions.
Right, consideration from the board.
Yeah.
Was this something that was not done before? Because this sounds like it's kind of new. Like last year was the first time there was this kind of a calendar was, or is it? Been
No,
just
this is the
revised.
first Time that we had really put thought into giving commissioners or giving anyone more time to review those budget documents instead of the last
Given us the last
meeting
meeting.
before we say, here you go, next one adopt, or the same. I'm trying to think how we even did it before.
The public hearing was held on the same day that the
Yes.
budget was adopted.
Yep.
So
What?
now we have the public hearing,
Okay. Well, I appreciate you doing this because, boy, I've been raising my hand a lot. Not having time to look over the budget. Yeah, we need time for that.
I think this is the second year with the expanded and worked well last year. And I just remember there were some very significant budget issues that came up 2 weeks before we had to adopt the budget and didn't give time for adequate discussion by the board. So
Yeah.
this works out.
So do you feel, based on your experience from last year, that this will allow the board to have enough time to have those discussions?
I do believe so.
Okay. I'll have to,
Would you like to make this motion?
yes, please. I move that we move to the regular board meeting to consider adopting Isabella County fiscal year 2024 budget calendar as presented.
I'll support that. All in favor signify by saying aye. Aye.
Aye.
Opposed, same sign. Moves forward.
Excellent, thank you. It's hard to believe we're not quite wrapped up with audit, but here we go.
Again. And each year now is getting to be more exciting.
Mm,
I'm glad you think so.
mm, mm.
Next one is consider accepting and placing on file the fiscal year 2023 first quarter fiscal report as presented.
Yes, sir. So Don't fall out of your chair, Commissioner. This one always looked really bad.
I've already looked at it and yeah, it was,
Again, it's because of the majority of our revenues come in the form of
Right.
property taxes. They don't come until after the July 1 tax bill in our last quarter. So we always have a terrible looking first quarter report. And you'll see that tax revenue is at 0.93. Wind turbine revenue, we do break that out because it is so substantial, is at 0%. And again, it hasn't been levied yet. It won't even be levied until July of this year. We do, if you go down to the bottom of revenues, we do, when it gets to be more pertinent, when we start to get our tax revenues in, this will become more important as you see this, but we do take revenues, the taxes out of revenues, and we say,
Mhm.
okay, revenues excluding property taxes, because, okay, if we know those aren't coming until later in the year, well, what
Mhm.
is it without them?
Correct.
And that always still looks bad, but not as bad. So let's see what's feeding into this total revenues at 6%. Without taxes, we're at 17%. We would expect to be at 25% at
Right.
the end of the first quarter. But a lot of things lag, and a lot of revenues that we bring in that first quarter are attributed to the year prior.
Mhm.
So even though we get them, we have to push them back. So our first quarter generally always looks pretty terrible. Things that are looking pretty much on track. We do have charges for services at 22%. It seems to be trending pretty strongly. Fines and forfeits the same. We have, I think, brought those budgeted numbers down, so we've been conservative, but looks like they're performing very well.
Mhm.
I have revenue like the delinquent tax revolving revenue is built into the budget this year at $200,000. It's at 0% because we don't transfer that over unless there is a need of general fund. Some of our other, we'll look down below the transfer in like indirect costs at 25%. Those happen very regularly. But the delinquent tax revolving, we have said, if we end the year in a, basically a positive, we're not going to add to general fund balance, taking delinquent tax revolving fund balance, if that makes sense. Like in last year, I think we had budgeted 800,000 throughout the year in a budget amendment. We had reversed that out basically because we didn't need it. These other transfers in from other funds, commissary helps to cover those capital items that the sheriff has requested. So that's at 25% because again, it's just every quarter we bring in a quarter of that. Transfer in from CPL, that is under the clerk's direction. One of her employees is partially funded from her concealed pistol license fund. And so we transfer over those amounts quarterly to cover the wage. Transferring from other funds, that 11,000 is for Register of Deeds automation fund, and that's a transfer that we do basically once at the end of the year. So you will see that 0% for a while, and then the indirect costs at 25%. Again, not terrible. Based on how we generally do look the first quarter because of those revenues that we have to push back and revenues that we haven't gotten yet. On the expenditure side, though, that's certainly something we can control, and we wouldn't expect really to see many of these going above 25%. And as you look in that right-hand column, you'll see almost every department even coming under 25%. Admin's at 30%, largely in part because we pay our property and liability insurance out of administration. It's a large
Chunk of change.
It's a large chunk of change, and I think we've paid 50% of that for the year. So that's what pushes up our percentage. Another percentage that is high always is the cooperative extension. That's MSU Extension Office, and we have a contract with MSU for that program and those staff, and we pay that ahead. And so we've already paid 2 quarters by the end of the first quarter, if you will. Community development is a little over 25%. That is in part because of the escrow that they hold on the sight and sound investigations on the wind park. And so a lot of, looks like there's, I think probably because of the sound study recently performed, there was a lot expended in that department. Now, it's budgeted for, and that's an escrow, as Mr. Neefort tells you, that's paid for by the developer. But the expense has to happen, and then, kind of the escrow covers it. But it is a budgeted expense, and we've just, we haven't overspent. We're just spending a little more than we would have been trending in the first quarter, I guess. Everything else you're gonna see at 25% or below. Veterans Affairs is at 32.93%. That's in part because of the county veterans
The grant.
grant. Yep, exactly. And those grant expenditures that he's already under contract for and already started to spend for the billboards and the bus wraps. And our transfer out to MIDC, we do that once. We do that at the beginning of the year, and 100% of it goes into that our MIDC fund. And so yeah, what you will see at 100%, and that always drives up the transfer out percentages. So thrilled that total overall end of first quarter, December 31st, 2022, we were just under 23% expenditures. And you'll see why that's important when we get to the next piece on the agenda about how we finished fiscal 22. But the department heads, the electeds, the staff all do a really great job here of staying within budget. Really, really do. The last page of that first quarterly report are some of our major funds besides general fund. We look at parks and recreation at 2%. Now that's for a couple of reasons. One is mostly because their season hasn't started yet, right? And they will get geared up here pretty quick. Friend of the court, they look like they are really lagging in revenues at 10%, but that's really a reimbursement thing. So I think part of it is you'll see the expenditures at 23%, and then we put in for the 50% reimbursement. So it just lags coming back, timing. Commission on Aging, 4%. So their tax revenue hasn't been attributed to their fund yet. They are a December 1st levy. So I would expect to see some revenues in their fund by now, but maybe we don't recognize it that way.
Plus they get the funding from the state or the regional agency, which I don't know if that's paid out quarterly or lump sum or every twice a year.
That's a great question. That's not a reimbursement thing from the Region 7. That all comes over.
No, those come over
Monthly.
but those two, just like a lot of the grants at the state level.
Lag.
We're submitting timely. State takes a little bit longer to get it.
And I would bet in first quarter, our percentages are really low because you're pushing back anything that was attributed to fiscal 22 and taking it out of this first quarter report.
In
So
October, November, December, we're still getting things past August, September. From previous year that we accrue, so that revenue is out of there, and then we wait for October, November, December.
Finish up.
thank you. Child care fund. Well under budget expenditure wise, and that drives obviously the revenue down because it is a 50% reimbursement on that. Although I hear in the state budget that might be going to 75%. Very exciting.
Good deal.
Yes, that could be a good deal. Central dispatch revenue. Now we don't fund central dispatch with taxes. It's a surcharge on your phone bill. Anyone that has their phone bill mailed to them in Isabella County has that surcharge, and it's sent to us from 100 and some different phone companies, right, that collect that surcharge. So Central Dispatch gets all of those checks and deposits them, but it always comes, it seems like after the fact. We're always pushing that surcharge back to last year, so don't be alarmed. Our 1.5% revenue It's coming, it's coming, it's coming. More importantly is that their expenditures are under 25%. You'll see inspections in the MRF both performing very, very well. Within their, within 25% you'd expect to see for the quarter, and MRF revenues do again lag a little bit. Obviously there's invoicing and then payment from folks for the commodities that we sell to them. So a little bit of lag in timing there. Any questions on the first quarter report?
I don't have any, but you might want to explain for Commissioner Embry, there is one other piece of the puzzle behind the scene, and that is, since we don't get our revenues until like the third quarter,
Right.
and we're constantly paying our bills, that we have to rely upon assets, other financial assets to
I was gonna say,
balance
that's
it
my next
out.
question. That was my question. Exactly. Okay, so how do we, so there's a lot of money going out, no money coming in. We seem to have a disparity where then all of a sudden we have a lot of money coming in and not a lot of money going out. So it's kind of, so you got money coming in, no expenditures, and then it does this reversal.
Mhm.
So we have money set aside on an annual basis that we do that just because we know this is coming.
So a couple different things. We do have money set aside in fund balance, right? And we do
Okay.
have a couple $1,000,000, 2 million to be exact, in fund balance of working capital. That is supposed to, 2 million is not enough, as you might imagine, with the size of budget to carry us with cash flow. But as Chairman Jalazinski has said, it's other funds that we are holding and help us to get through. Treasurer does probably a daily dance for cash flow purposes, right?
Mhm.
Keeps us solid throughout the year of cash flow. It gets really tight when you get into May, June,
Yeah.
1st of July, before the treasurers bring in those taxes.
Right.
So they do a really good job of keeping our cash available and letting, alerting when cash in any account is getting low to transfer from where they're able. But you can imagine cash is not fund balance, right? Fund balance is not cash. Even in July 1st, when our cash flow might be the worst of all for the year, we still have $11 million fund balance. But none of it'll be cash because it's all been fronted
Mhm.
to pay the expenses before that cash comes back.
Right.
Um,
So it sounds like you're almost like you're borrowing from yourself to pay the bills until the money comes in.
Absolutely. I think that's probably a good way to say it. I don't know that we borrow, but we
No, it's
transfer,
Transfer,
right? We transfer.
So based on experience.
That's right. We have an issue with those terms. So,
Yeah,
but yes, same concept though.
yeah, so it's a
Whatever you
concept
call
that
it.
I'm used to, business concept. So, so this idea of you need experience from prior years to understand what kind of monies you need set aside. So you've got to be able to project this out from the first of the year through July, August. So you've got 6-7 months in there that really you're struggling with determining the amount of cash you need on hand to keep yourself solvent, correct?
Yes, sir.
So is there a tool that you use? Is there? How is that figured out?
Well,
mean,
I know in the past, there were some questionable things that a past administration did in terms of transfers. I didn't feel comfortable with.
Mhm.
I think they needed to have more transparency, which never occurred until kind of spoke out on the issues. But a lot of counties, when they know they're going to have this issue, will borrow money up front to take care of that. I think we do have some appropriate funds that we can use. And I think with the administration communicating with the treasurer's office, we can do that now. As we move on and start financing this jail bond, some of those resources are probably going to
Yeah,
disappear.
that's kind of-
So we may have to go the loan route to
Right.
get us through the lean times, but
So I guess my question is, in this process, and obviously based on what you're saying about previous administration, what I see is an opportunity there for us to be not informed very well or not on top of this, and I do not like not being on top of finance. I don't like this idea of getting information at the last minute or having to make knee-jerk reactions to financial situations. So that's the reason I'm asking, is there a form or a formula that's used, or is there a daily, monthly report or some kind of report that we could get on a regular basis that would let us know, this is kind of where we're at dollar wise?
The cash flow wise, we can run you balance sheets, at every one of these finance meetings if you want. If you want to see maybe, you know, even Fridays when the invoice list goes out, we can send you a balance sheet along with it. That, you know, that's gonna show you your cash,
Right.
for general fund.
We
Yeah.
send it out quarterly to you.
Oh,
uh,
yeah, this is the guy I want to talk to right here.
Yeah, we send it out quarterly, you guys. We can send it out. We do it every day.
Yeah.
We have a cash control sheet every day.
So you have it, right?
We have,
Mm,
if you don't have a cash flow analysis, we've never had that. Which would really help in many ways. And we ran across some situations where, you know, we want to invest this money, we want to get it the best we can.
Right.
You know, usually it's a longer term type of thing to get you better rates.
Correct.
The needs, we need to know what the needs are gonna be and about when it's needed. The road commission is very good at giving us the updates and stuff.
You're gonna plan all.
Yep, we have a plan. We go by what they say. Investment, so, ladder it out so that we have funds available, cover cash flows. But, yeah, I mean, with the time, with the jail coming, we got to get on top.
My understanding is between you being comptroller and using the treasury, to see if there was a potential cash flow issue coming down the road, you would advise us of that well in
Well,
advance.
we've already had one.
Yeah. I'm kind of going, right?
Yeah. Well, it's a matter of, we didn't know that we had to make up the difference in the jail. 13%, is it?
It's 12 now, I'm happy to say, but yes,
12%
Yes.
for every, we don't, my understanding originally was that we were gonna get the money from the USDA.
the 41.5 million.
That don't happen. They're hanging on to the money. We're submitting bills, they're reimbursing. Okay, so.
But not the whole cost because we're over budget.
Minus 12%. Because of the cost of the thing that's going on.
Right.
So we had a bill come through from construction people that we could pay because they have to come up with our portion of it.
It wasn't that the dollars weren't available, they were tied up in investments and the
Right.
cash
No, I
wasn't
understand that.
available. I didn't want to
Saying, 'cause
cause
when
any.
you laddered there. You
Yes,
only have so many things that are gonna come,
Right.
due or whatever.
We don't know, from the construction people, I guess, we get a better understanding on.
Shouldn't they give you some kind of timetable of when things are gonna be done and how things, give you rough estimates of how much?
they actually just did, yeah, they actually just submitted it to us last week with a nice cash flow for the whole project, so we can get out in front of. This was
Yeah,
the
'cause that's-
first,
Right.
this was the first draw on a Clark invoice that wasn't reimbursement from the bond anticipation note expenses. So this
Right.
was our first shot at the draw, and we goofed it up every, 6 ways since Sunday, I think. And we've got a process down now to where we're actually we get the invoice from Clark Construction. We don't have to show USDA that we paid the invoice before we seek reimbursement. So we're able to now submit the draw request to USDA, 2 to 3 days, have the cash in the account, cut the check to Clark so that we can get out in front of the
That
cash
was
a
my
little better. And that's just
What's the first-
communication. What's that?
Correct.
Correct. They'll reimburse us off of that invoice. So in a way that is fronting the money, but certainly not to the 41.5 million. It's only fronting each draw that way.
Okay, so that's how we
Yeah.
stay out in front of it,
Mhm.
to avoid any potential cash flow issues.
Yes,
Okay.
communication,
Coming
that's
up-
our biggest.
Coming up with the 12% cash,
That's something you probably have to pay. Yeah,
Mhm.
$41 million, 12%.
it's 41. Yes.
Yes. Any percent of a big number is a big number.
Thank you. Appreciate that. All right, sorry, I
So-
didn't mean to
We're gonna
totally tangent.
always have these cash flow challenges and sometimes we get hit with a surprise that we have to deal with. But I think working as a team with administration, the treasurer's office and the county board, everybody works together and it's not doesn't become somebody's fault.
Right.
It's a combined effort to continue to be solvent and serve the people.
Get out in front of it.
So-
Yes.
Real quick, yeah, one other thing, so I apologize. All right, it's a matter of form. All right. On this financial comparison budget to actual general fund. That $20 million amount over there, really, I had to go take a blood pressure pill when I first saw this until I started looking at it. What I'm interested in, is it possible to just do a quarterly budget, a line or a column? You have a 23 original, you have a 23 amended. We had a 23 quarterly budget. Then the actual would be an actual comparison of what the actual budget is for that quarter. And then you could see the dollar amounts, and then the percentages should all be 25%, give or take. And that way I could really see where I need to focus. I mean,
So
personally, if I had
you're just
questions,
saying take the budgeted amount divided by 4 to come up with the quarterly budget,
kind of, yeah. I
basically.
mean, I understand how this works, because everything should be 25% or less. I get that part,
Yes.
but just from a dollar perspective,
From
I don't know why, I just,
From the blood coursing through your.
yeah, I just thought,
perspective.
well, it's a thought, to help, just to see where the actual dollars, because boy, I just feel like because our cash flow is inverse to our bills, sometimes it's
Mhm.
cash flow goes down here, and expenditures go up here, and there's just too much room in there for a lot of questions for me.
I think those of us who've been on for a while probably understand that
Right.
and can see that in the
Yeah.
figures and
You know that,
Uh,
yeah. Okay. Just
Yeah,
a format thought.
no, yeah, absolutely. Anything to help make the numbers more comforting. would be
And,
good.
maybe easier to understand and also to be able to ask questions about, because
Mhm.
other than looking at
Absolutely.
percentages. it's-
It helps maybe to bubble something up too, right?
Yeah,
That-
no,
That's out of
Mm.
the norm. I like it.
Yeah, because that's gonna lead me into when we talk about the 12-month prior.
Okay.
I've got questions there, so.
Excellent. We're gonna get to that
is
next.
Chairman Hope still on the?
He
line?
is, he's not sharing his video right now. So, but he is still on
Okay.
and hopefully listening.
You haven't had any comments or questions?
I'll wait until public comment. Think so.
Okay, so then I will move accepting and placing on file the fiscal year 2023 first quarter financial report to the work session for consideration.
Support.
All in favor signify by saying aye.
Uh,
Aye. Opposed, same sign. Now we're going on to number 7, which is considering accepting and placing on file the fiscal year 2022 preliminary fourth quarter report as presented.
Super excited about this. I just can't say enough. I want to skip ahead to the end because we're about $2 million unspent, right? It's about to 24.5 amended budget expenditures, 22.5 actual essentially. So there's our saving grace from fiscal 22. About $2 million unspent expenditures. So if we start at the beginning, again, same format as our first quarter we just looked at, but this is, we put this on there as a preliminary year end. This is the first we're seeing the fiscal year end numbers. This comes from the work done on the audit, right? Why they're here. And this is why we know, okay, there might be a few little changes, but at this point, this is pretty much what the numbers are going to be for fiscal 22. 98.8% of taxes received, 100% of the wind turbine revenue, right? Nothing left to collect there. We knew what those were going to be because we had the values. They are what they are. Taxes, we're under by about $200,000. And Treasurer Pickens, if you could remind me, wasn't there was a tax tribunal case with like a chargeback is that what caused that in fiscal 22? It seems like there was a a tax tribunal case at the end where their values were lowered and we had to send back tax revenue.
Even several of your apartments have all cashed in. Yeah, new assessments. Kids doing remote learning.
Yeah.
They're not as small, so they can manage that before tax structure that says based on income, you can base it on value, you can base it on occupancy. Yeah. So they've been rewarded graciously.
Take it only thing.
Yes.
So it's not like we didn't. It's not like we didn't know what the taxes would be. This is one of those cases where it was reversed on us, right? Death and taxes, not always, right? Sometimes it goes away.
Sometimes
Tax
it's COVID.
tribunal can do that. Yep, exactly. So a little disheartening, but not overall damning to us yet. Licenses and permits, you can see everything faring very strongly. The federal and state line, that amended budget of 5.9 million and the actual of 3.9 million. What that is the budget, we had budgeted to use $1.6 million in ARPA revenue to cover payroll, to balance the budget at last summer when we're struggling to, how are we gonna resolve this? We built in 1.6 million of ARPA revenue. Throughout the year, through budget amendments, just like the delinquent tax revolving of 800,000 that we amended out of the budget. We never took out the 1.6 ARPA from the budget. We left it in the budget, but we ended up at the year end, we didn't have to use it as revenue. Our 92.54% of revenue was enough to cover those expenditures. Remember, we didn't have $2 million of expenditures we thought we were going to have. So it makes sense that we didn't have to use the 1.6 of ARPA. So that's why that percentage of revenue is about 67% of that federal and state. If we would have done a budget amendment to move that revenue out, then we could have had a nicer variance here, but
Percentage would look better.
So
Percentage
would that have
will
been
look
a
better.
direct pay out of ARPA then?
nope, that was under the lost revenue.
Okay, because
That was
I
under the lost
thought that one figure was higher than what my mind was telling me it should have been.
In that spreadsheet that we gave you, that's exactly right. That's exactly right. And so it's still in that 8.6 million of lost revenue that we have from ARPA. If we would have taken that revenue, that lost revenue bucket would be down to now more like 7 million. Yes.
Did you recognize it at budget time though?
No, we did not. I don't think did we recognize the 1.6 ARPA at budget time? I don't think we recognized it at budget time. I don't think we recognize it until we actually apply it to payroll, correct?
No, we did recognize.
We did recognize it.
You did
And then
recognize
we.
Oh,
put it
but the
back in.
cash is tied up in investments, so we have to move it back.
Well, if you recognized it as revenue, can you put it back? My question.
I think so, and because we haven't reported it as recognized.
Correct, absolutely.
It was just only done on our end. It wasn't reported to the feds that, hey, we used 1.6 million of ARPA dollars for payroll.
It wasn't in our single audit for the audit for fiscal year 22. I had asked our auditors and Steve Kernick on that. But yes, that does leave the tie up of cash investments, because at one point said, here's our revenue. Let's put it in investment as it should, and we reverse it. So there's just a little bit of time in between when we can or get the cash back into our pots instead of the receipts.
Good questions. Good conversations. Okay, charges for services. I know this was, I think at budget time, we had really been conservative about this through the year. We had amended it up a little, and then came in over what we had even budgeted for. So that's really good. Charges for services had really suffered over the pandemic. And so
Yeah,
it's nice to
so-
see those
Coming back.
coming back. Yep.
Mm.
Fines and forfeits fines and forfeitures, performing fairly okay at 82%. It looks like maybe we shouldn't have amended the budget up. I think that early on in the year, we had a really big forfeiture of a bond, and it was a very large bond, very unusual, and that kind of skewed our trend. So we thought, oh, let's bump that really up, but it didn't come to fruition. Interest and rents. Thank you, Treasurer Pickens, that overage of at least $70,000 over what we had budgeted for interest, right? Who would have thought interest is now a revenue line again? Yes, yes, thank you, Feds, for that. And to Chairman Jelezinski's point, the interest can be an expense if we are doing, he was talking about a tool of a tax anticipation note.
Mhm.
Basically, that's the form of borrowing that becomes if you need that cash flow. So then you have a big number of an expense for the interest on that
Interest
loan,
alone,
right?
yeah.
But for right now, interest is a revenue. We're excited. Other revenues, performing extremely well. Delinquent tax revolving, again, we had amended that down to 0. We needed it at budget time, but throughout the year, when you recognize you don't need it, you can amend that back out. Transfer in from commissary, again, used to cover sheriff's capital, CPL, you're seeing all of that transferred in to cover a wage. Transfer in from other funds, this again is that Register of Deeds automation fund. And if you recall, Register of Deeds, Karen Jackson had a big change in who handled the remonumentation grant last year. And I think she went a few months without any activity on that. I think getting caught up now, but I think that's why the transfer is so low, so under budget last year. Indirect costs at 100%, that's where we charge those other funds for the costs of my time and the accountant's time and payroll's time and Treasurer Pickens' time and IT time and facilities and all that. So for the FY22 ending revenues at total of 92.5%. We just talked about $2 million unspent, so I guess I'll say how this is turning out. We understand. Right at the critical moment of me announcing, but just looks like we're going to add to fund balance just over $700,000 from fiscal year 2022. We had at budget time, we had budgeted to use about 310,000 of fund balance. You'll see, Commissioner, this summer.
Okay,
We'll have pretty soon, we'll have the preliminary department requested budgets come, and we'll be very, very, very upside down, right? Millions and millions and millions of dollars upside down. And then we start to tick away at that and say, okay, how can we produce a balanced budget? At the end of it, you'll think, how could they pass a budget to use fund balance? But at the end of the day, we've exhausted all of our conversations and comforts.
Mhm.
And now we're down to, we have a nice healthy fund balance. Can we use some of it
Mhm.
to balance the
That makes
budget?
sense,
So
yeah.
we've traditionally done that throughout several years. Doesn't always come to that to use it throughout the year. We can adjust that through budget amendments, and we do try to do that. But we never know until it all trickles in at audit time. But
It's good to have it. If you've got it, it's good to have it. And if you need to use it, you've got it there to use.
exactly, yep,
Yeah.
exactly. So that's the big story. We can certainly look through the expenditures, but I can tell you that absolutely no department is over 100%. We just that's just not how we budget, right? We're a team and we help each other out, and so no department goes over budget, God willing. In general fund. Do you have any questions about any of these percentages or why? I'm trying to look for an anomaly that might be really low. Landfills at 50%. Expended in part, that is because we are, as I understand it, this we're more than 20 years past our landfill closure agreement
Okay.
with the state, and so the testing requirements, sampling, requirements and testing on the groundwater out there is not as rigorous as it used to be.
Okay.
PFAS was kind of becoming a thing to where we might spend some money on that, and we do budget. We have a contractor, Golder, I think is the name of it, that helps us with the landfill. And they do all those testings. We contract with them, and testings have been down in years past, but we still have to budget for those tests.
Okay.
Other than that, we've got a Human Rights Committee at
Yeah, I saw that,
43%. They don't have a very big budget, about $6,000 for the year, but they're really good about staying in budget and not overspending. So,
Okay, so as you move into budgets for next fiscal year, are we going to continue to anticipate future tax decreases, tax revenue from the student housing? Is that, or do we anticipate that housing?
So
Tax.
how we anticipate tax revenue in the budget, it always starts with equalizations report about, how much is taxable value going to increase next year. And that is capped at 5% or the rate of inflation, whichever is lower.
Okay,
That's where we start. When Melissa and I apply that percentage to current tax, we carve out the wind turbines because they're on that
they're on that.
depreciation that goes
Right,
down. You
they got their
can't
own schedule.
accelerate
Right.
those, carve them out. So then we take that accelerator from equalization on the rest of the taxes, if you will.
Mhm.
And then from there, we have to subtract all of the capture districts throughout the county, right?
Mhm.
Like a DDA might come in and capture a certain percentage of taxes to enhance that district.
Okay.
That's county operating levy that would have come to the county, but is now
Oh,
going
good.
to that other taxing authority.
Swept,
right?
it's just something else. Okay.
Yep, Melissa and I have figured in years past, it's a little under 4%. It's about 3.95% that is captured from budgets. And so we see that as a loss, and we just take that right off of the top, and that never is built into the budget, the budgeted numbers. And we normally we come in a little bit over budget for taxes because we are conservative like that. It's just this one instance or several instances. I don't think it was just one that led to this necessarily. So that is something at budget time we can start to do. We can plug in a certain percentage for additional tax tribunal cases that don't go our way. We haven't done that in the past.
Right, so those properties that have already come in and had their taxes lowered because of the occupancy rate, because that's what they're using, right?
Mhm.
They're using an occupancy rate. Are we anticipating that would continue, that they would have continued low occupancy rates? I'm not sure how this works, where they come in and they say, okay, well, my occupancy rate's 40%. They get their taxes reduced. Does it stay at that amount, or does we tax them based on value or something
It
else?
stays
and then
at
they
that
come
amount
back?
until that next either the rate of inflation or 5%, whichever is lesser the next year.
Biggest problem with that is there's no counteraction to it.
Right,
He was able to
Right.
come down in a fell swoop,
yeah,
but in order to raise it with Headley, he's going to do the consumer price index or
There is lower.
than 5%.
you can only get back so much of it, even if they go back to full occupancy. It's a
It'll
windfall for
It'll
them
take them 20 years to get
to get back to where they were before, to where we were before in terms of tax dollars.
Yep.
Yes, that's
That's-
part of why it's so damning.
Right, and
Damaging.
and if we're as long as we anticipate that when we're budgeting, say, okay, well, that's where we're gonna be hurt in that.
But it's
area
hard
for
to
the next 20
anticipate,
They
right?
calculate tax values,
Right, see, they-
and we have a pretty good number with equalization of tax values.
Right.
And so those are all adjusted by the time
that
they're
we
getting
get,
their numbers before we
okay,
make a
before we get,
decision.
sorry, factored in. Got it, okay.
Just a follow-up question on that, and that if they're going up to 100%, it doesn't go back up to the what it was. But if they're appealing the tax based on a 40% occupancy rate, it's not a 60% reduction in the taxes, right? They make
it's up to the tribunal judge on what they figure is equitable. Their terms. So, it may not be a 40%, but they weigh it. You know, they weigh all three factors, or four factors now.
Okay, I apologize. I like the looks of what the report's saying. I had to take that call.
Oh, I-
We understand. You did walk out at a pertinent time, though. If you can see from the front page, we are looking to add about $700,000 to fund balance from fiscal 22. Thrilled. I was explaining to Commissioner Embry, you know, how generally at the budget time, we did adopt a budget with use of fund balance, right? We assumed that we were going to be using $300,000 worth of fund balance, instead adding 7. So that's $1 million swing from budget time. And so as we go into the very scary department requested budget here in a couple of months, just keep that in mind.
Yeah.
Keep that in mind. I think, you know, actually Commissioner Horton tried to get us to go down that road. You remember at budget time last year, we were having such a hard time balancing. And he says, we always leave expenses on the table. We always leave, and we do, and we've left 2 million. So as a budget, you know, strategy at budget time, when we're trying to balance it, I think that's something we should look at.
Fine.
Yeah, and keep in mind.
I definitely like this idea of under promising and over delivering. I'm really big on that. That's why taking numbers in the green is always a good thing. And
Yes.
like I said, being able to add $707,000 back into the general fund balance, that's awesome. It's good
It's a
to
function
see.
of every single employee here.
Exactly. Move that we consider accepting and placing on file the fiscal year 2022 preliminary fourth quarter report as presented.
And add to the work session.
And add
I'll
that to
second
the work
that.
section.
All in favor signify by saying aye.
Aye.
Opposed, same sign. All right,
Okay.
our next item, which is probably pretty exciting too, is
Hmm.
well, maybe not. I just saw the grimace on the face. The 10-year financial forecast
No
update.
one does. This one doesn't go in the packet.
Okay.
This one gets handed out at the meeting, or we didn't even, did we bring we make handouts? Could we maybe print them some? That would be great. That would be nice. I will share it on the screen right now, and I will try to let me
I think
see.
that's really small.
I was gonna say, I have
Yeah,
to get up there
maybe-
and dig into
maybe-
this little.
So don't have a stroke.
No, do not have a stroke.
Yeah, I didn't bring pills with me, so yeah.
What's that? You think I am?
That was all the kids.
This one's February 14th, 2023.
Everyone in there is.
I'm not in the shared drive right now. I'm going by the one you emailed me. Do you need to email me a new one to share? Okay, can you do that? All right. My apologies.
Sorry, I thought
We're
you
gonna
were
take a
going
little
off of that
break.
one, or I didn't- I
No,
didn't
I'm
send
not,
it.
I'm not remoted in,
Gotcha.
to.
Or is it worse?
It-
Well,
Yeah.
yes. I like that.
Or you could join the Zoom. Oh, here it is. All right, I've got it. I'm opening it. Okay, and now I will share my screen. I can. And thank you, Melissa. I'm glad I
Yes,
didn't get
apologize, I was
too far
thinking
down
that-
the road.
Yep.
Without that. Okay, now I'm Zoom. Let me know when.
There we go. So better.
Oh, how about this? Too
Oh.
much.
Oh,
Maybe. custom, we'll do custom 125. Looks like it's. Oh, you have to actually click on it. Okay. Why won't it go back down? Okay. Is that gonna be big enough? She's gonna grab some off the copier, but I'm hoping that this is big enough for our purposes to see. If not, we can certainly move up too.
And this will be presented at our work session.
Yes,
So it'll be up on a really big screen
yes,
there.
and she's gonna
And then we'll
grab
hand
you these two. Please make sure Treasurer Pippins gets one.
Oh, yep.
as well. No, I've got it right in front of me, so I can see pretty
Okay.
well here.
Sure.
Okay, so I don't know whether to scroll down and give you the bad news or tell you what's built in. I think that I want to go to the expenditure page and explain, well, you're not going to see this in front of you. Explain what we did on the forecast itself. Up on the screen, do you remember the original forecast it broke it out between salaries, operations, and most departments had capital outlay. And we said right away, well, when you put a multiplier on salaries and benefits, you're changing the wage, you're changing the healthcare, you're changing the
Right down the line.
defined benefit retirement, you're changing the defined contribution retirement. It doesn't make any sense. So what we did, I'll zoom in closer so you can see this hopefully. So what we did is we took the salaries and we said, okay, let's break it out. Logically, we said, we're going to take out FICA and make it its own line. All of the insurances, disability, life, I think workers' comp is in there too. Retirement for defined contribution, because that's 7% of salary, and defined benefit retirement, because that's our MERS pension. That's where that unfunded liability sits.
Yep.
And with the tools that MERS has given us, we were actually able to, I'm gonna back out of this Zoom now. We were actually able to see what our MERS would be with the negative 10% year that MERS has just had. Remember, MERS assumes 7% return on investment
And then
with a negative 10% actual. So now we're looking at basically a negative 17% swing. So what does that do to our defined benefit retirement for next year? The way we do this is Melissa and I go through and we add up all the defined benefit retirement lines, right? And then we know from the MERS tool where our MERS payment's going to be going forward because of that negative 10% year. And the multiplier we had to give defined benefit retirement to get to that amount that we need to send to MERS next year was almost 25%.
oh my
I don't want to give you guys whiplash, but if I go to the bottom, I should be able to see that number, right, Melissa? That DB, would it be that there, Melissa? Let me see.
No, it would be
20
down.
It's not going to be the
Scroll over, should see a column there, it'll be B column, it'll show you exactly what you saw.
B column.
B, yep. That'll show what each of those are, the first one, salaries, there.
Ah, gotcha.
So, yeah,
Thank you. So we're
323, yeah.
going from 1.8 to 2.3 million.
That's general fund portion.
Yes.
2.4.
Yes. And then, and that tool that MERS sent us actually shows we're able to go out about 5 years from current. So we can see we're continuing to go up. And then in 27, we do start to come back down even with the models we have. But instead of just dropping off in 2028, we're looking at 2.5 million. 2.7, and that's kind of where we left it for the remainder of this forecast.
So, but okay, so in the MERS forecast, so we had the -10. No, for this year, what did we decide? Stay the same?
We did 7,
Seven?
right? We just did 1 year at 10.
We did stay the same for this year.
You said, so you're thinking we're gonna return 7%. So this, in my estimation, is going to be real close to 0, if not negative again. So that could be another additional cost to us for MERS that could be exponential if it again ends up at -7 or -10 or some large negative number.
Absolutely.
So we could be
I
tough.
think the thought process on this too, I know it's a forecast and it's ever changing.
Right.
We could Put in 10 and all, and we will, that's what we're gonna use this for. But at this point, we said, let's go with what we know right now. I think we're maybe a couple weeks out from, Tony, who is here.
Yeah.
We said it's gonna be about 10.3% negative. We're starting with that. And once we kind of get a couple more months in, or by the next quarter, when we bring this, we may know more for how this year is going. So then we build in a negative there, or we see, so we can change that and.
Right, it's a point in time.
Yep.
Yes,
That's all these
and
are.
it's always that, do we start plugging in different?
Different scenarios,
Yes,
different options,
it's
different
a
returns,
rock
if
and
you
a
will.
hard place, yes, if
Mhm.
we can put it in, the negative, I guess we could do that, and then always predict the worst.
Yes,
And then it's not so bad, bring it back.
Yeah.
That's
kind of where I go.
But just for, to not get too much in the, I guess, in the weeds, we know what 22 ended up being, we're gonna plug that in here and then.
So you're doing best case scenario, essentially. If you're saying we're gonna be 7%, which is what MERS believes will happen, just as a starting, so the starting, but we'll start at 7.
Yeah, for the starting point, but as it goes on and by next quarter, when we bring this, we might know more, we might see. Into March, April at that point, and.
Okay.
Put 0 instead of 7. We have to put those numbers in and update this again.
You and I already talked, we're gonna get together and do that
Yeah, yep.
on our own.
Yes.
Okay.
Or as a team, either way
yeah,
is
we'll
fine.
do that. Okay.
One thing, we brought this forecast to you several times throughout the last few years, and we keep improving. One way we really feel is breaking those wages out, to be able to send that multiplier just on the salary, not on healthcare, not on the same multiplier on FICA, we realize, but it doesn't make any sense to apply the same multiplier to your defined benefit as your defined contribution retirements.
Right.
Right. And it just doesn't make any sense.
Makes
So
it more accurate.
it does. We believe more accurate. One thing we heard loud and clear from you too, when we brought it before, is we need more money for capital. So one thing that this forecast does is, Melissa, help me with the numbers, if I'm incorrect here, but it adds $250,000 each year to the facilities budget in general fund for capital improvements. And if it's not spent, essentially that the remaining dollars goes into, just like our court technology fund, will go into a line that would just be, assigned for facilities improvements, for those surprises that come through. But this, in fiscal 24, there is a 2.4 million now built in as a one-time expense in facilities for ARPA dollar funded HVAC project on this building. I wanted to make sure that was, built in somewhere in the forecast. So if you see that in 24, why the major expenses, why more revenue? It's that one-time project ARPA dollar influx. In addition to recognizing that facilities might need ongoing capital, so might information technology, right? Our IT department. And this forecast builds in $50,000 a year for IT improvements as a probably conservative, but you got to start somewhere kind of number.
Yep.
So I think those are some important things to mention on the expenditure side. Melissa, anything more expenditure side wise that you want to talk about that we built in or changed or was important? And breaking out the wage was the big thing, I think, for this round. Just to be more accurate.
The only other thing is in 2023, for the transfer for expenditures, we will see us paying the van off
Yes.
and also and 2024, the transfers out are significantly higher than when you start 25, 26 and so on, because we built in what our 12% that we have to pay for the correctional facilities. 2.5 of it, or 2.6 in 2023, 2.5 in 2024, and the transfers. So you'll see 2023 transfers out of 4.4 million, 4.3 million in 24, then we go back to our normal transfers. Because our 12% of the whole project is to the tune of
That's right.
12%.
Yep, that would be.
Geez.
Thank you, Melissa. That was a big expense that we got all done with this the other day and we looked at each other and said, we never built in the expenses for the jail project. You know, I mean, it's amazing that you'd think that would be where you start, but you go through these and you think, well, what about this? Well, what about that? Well, what about this? Well, that's coming out of fund balance. So thank you, Melissa. Super important.
Did you add an extra 20,000 out of each guy? It's just 200,000. Now it's 400,000.
It's always been the 400 starting in 2024. I guess on as far as the last forecast, maybe even the one before, but I'll check. But it has been the 4.
It has been the 4. I know at budget time this year, we went with 2, but I think it has been 4 in the forecast. We can go back and check, but we do, to your point, you know, we can walk through these revenues certainly. Obviously the taxes, the turbines are broken out. Now the turbines, I feel like we did apply the new settlement table to this turbine value. I can tell you in just a second because yeah, 860,000 we do. We have that new depreciation table so that we are seeing about, well, not the whole $2 million increase won't be shown on this 10-year forecast, but we are seeing a little increase in the turbine revenue from prior forecasts that you've seen.
Right, year to year.
They changed it. First year, 100%, second year, 80%.
No, and that's why it's so critical right now, because we're in year 2, right? We're about to apply the table that makes a difference. The year 2 on the new table is like 0.8037 or something, right? It's a little over 80%. Still goes down to 30% over time, but it goes to 30% over 15 years instead of over 10. And so you have these just fractional differences each year that add up to, I didn't figure out the percentage change, but
The dollar amount, though.
10 years.
15 is really where we're getting our dollars.
Right.
Yep. And then those year, like I said, those multipliers each year are just a little bit off, right?
But we
A little bit
still
different.
allow the bond payback. Is that all taken care of then? You just went through.
Correct.
You just went through a tribunal.
With Co.
Tribunal for the call, and they agreed to a less payback.
Yes.
That's still in the agreement.
Yes, because I believe the last payback is using this settlement table. All the lawsuits that were out there with DTE have all been settled with this table. And I know that the legislative fix that they're seeking, they've got some a legislative fix that they're trying to say, assessor, thou shall use this table. And they're using the settlement table, and DTE is in agreement with that. So it's really, yeah, it is really
There's
good.
also a push to
Good.
rename it as a utility, which would change.
The depreciation schedule would be even more damning,
Yes.
probably.
Yes.
So like transmission line, you know, traditional utility, personal property that we've had on the tax rolls for the start of the county is always a very, you know, consumers, DTE, always one of our top 10 taxpayers, right?
Right.
Just because of that infrastructure that they have. but it's not taxed at like what your residence is taxed at. And that's what
It's personal property,
he's saying.
it's personal property utility, which falls into a whole different category,
Which is less than,
which
course.
is less than personal property.
so that's why they're pushing for the designation as a utility, so they can.
Yes, I
Save
mean,
a few
it's
bucks.
out there, our legislative lobbyist presented that to our last conference here last week. And that was one of the questions, one of the things that they brought was out there.
Mm.
It's not been introduced yet, but it's out there.
Sure.
So this takes legislative action.
Mhm. It would, it would. And DTE is not the only one that owns wind farms, you know, right? There's other developers out there too. DTE, and especially through this recent development, has proven to be a very fine community partner for us. You know, they want to be here, they want to bring solar, they're not going to pull that stuff, right? But there are other wind farm owners out there besides DTE that would seek legislative solutions in other ways, certainly.
Hmm.
It's business, right?
Right,
And it's,
I understand.
it's big business.
Well, with the Michigan governor pushing the green initiative, that's what's really encouraging. The hoopla about, hey, if we're gonna do that, let us change the status. That was the going point. for that.
It's scary, very scary, yeah. Yeah, we're planning on $800,000 of ongoing revenue a year
Right.
from those farms, right? Because at
End of the year,
30%,
right,
that's what it'll be.
80, yeah, 860,000 more. Wow, okay,
Yes.
okay.
Oh, let's see, where are we going? We've got the ARPA dollars in the revenue as one-time uses. We didn't want to perpetuate those in the forecast, obviously. Charges for services, as I mentioned, are coming back strong, but we're not putting a huge multiplier on those. Fines and forfeits are pretty much flat. Interest is a revenue. I think there's other things in that. Interest and rents, I think, is what's in there, not just interest. Transfers in from DTE, like I said, I'm sorry, TTE, DTR. Like we had just mentioned, we do have at 400,000 for the forecast purposes. And then transfers in from other funds. This is indirect costs, right? This is a lot mostly. And so if we had other entities whom we were providing indirect cost services for, that number could grow. I know.
Great Lakes Bay.
Great Lakes Bay, yes.
Yep, okay.
Commissioner Embry and I have been in discussions with that organization about finding them a new fiduciary, which may be us. So that is exactly where that revenue would come in. Again, salaries and benefits, a lot more meaningful now. I feel like we've taken all of those and rolled it up. Melissa and I haven't had time to compare this to the old forecast that we've done to see how much tighter might we be with wages now that we've broken that out, but we're excited. So obviously, you know, our budget, as we knew, very heavy on salaries and benefits. Operations, we've got a lot in capital. Again, that's that one-time ARPA year. Remember, don't look at the 30,000 or 30 million in expenditures and think that's going to perpetuate. That's not what we're bringing forward. Debt payment, this is our interest payment on the jail project that we'll have to make. And then Melissa talked about the transfers out, having our portion of the jail project built into these 2 years of transfer out. So what I've been trying to hide, although it almost tells the story. Here's our net of expenditures and revenues every year. We're hovering around that $4 million mark every year of being short. If we take this out to the 10-year, it does climb to 4.5 million as we get, you know, a little more unsure about our numbers out there. But certainly we see that ARPA is the saving grace to get us through the next few years. And then there is a very, very large deficit looming, which is not a shock, right? We knew this is where this was going. It's kind of interesting to see that need though, year after year after year. Right? We talk about the MERS dropping off, and trust me, MERS will still drop off, right? Because
Yeah.
it's a closed amortization
Yeah.
system. We will
Right.
not keep kicking the unfunded accrued liability down the road. We
That
have a
ends.
certain amount of years to pay it off. But when they have a negative 10% year, we're gonna pay more each year. Because we have that date certain to pay it off. It's damning to our 10-year, but we will have that point where MERS falls off, where MERS trails off. I shouldn't say falls off, because we still have that normal expense, right? I think, when I think back to our actuarial, I want to say like our normal expenses, maybe a couple $100,000 a year,
Oh, it's minimal compared to what we're dealing
right?
with now.
Compared to the 2 point. Maybe
Well, it was over 5, but.
for the normal
maybe
cost.
I was thinking medical care in there too, so.
But affordable is the point,
Yes.
right?
Yeah.
Normal cost is affordable. We have no problem carrying that forward. It's the
reasonable.
unfunded accrued liability to get there.
I see two more expenditure impacts potentially. One, if we do the salary study, what's the outcome of that? And I guess we could ignore it, not make adjustments, be competitive. But then we're gonna have a problem with people leaving and not having the ability to get good people back. And then the other one, which I don't think is reflected on here, at what point are we gonna have fund balance issues where we have to then borrow money to pay the bills? And how much are we gonna have to borrow, and where is that interest amount gonna be?
It's really what, and I've brought that up. Well, you've got it in front of you. So
Mhm.
the ARPA dollars again, is what is gonna get us through the next few years. And that's, like I keep saying, manna from heaven. It's not anything we planned for, had saved for. It just was grace to us, and it is our saving grace. We will run into real issues with fund balance, starting 2027, 2028,
I'm
right?
thinking
And
2027.
cash flow is gonna be a problem well before that, to your
Mhm.
point, Commissioner, that
Mhm.
cash flow always becomes a problem before fund balance.
That's what I meant, cash flow, when I,
They're
Yeah.
both gonna be a problem.
Yeah,
Cash flow is gonna be a problem before fund balance. Fund balance will be a problem in 27
right.
if we don't.
So if we're not on top of this real quick
Mhm.
and have a game plan in mind,
Mhm.
ooh, where those numbers off to the right are not pretty.
No, I know, and it's interesting, Commissioner Ember, you might not know this, but it was the USDA really that caused us to go with a 10-year forecast. We had been just forecasting a few years, and the USDA said, well, that's really nice of you, but we would show them little snippets and they'd say, but what's happening in the rest of the county while that's going on? What's happening, down here? And it was really the USDA that encouraged us to go with the 10 years so that
Yeah.
we could prove things out. And ever since then, it's been quite a scary affair, but obviously a valuable tool, even more
Yeah.
valuable now with, I think, the wages broken out with. And remember, this is, if we could have everything, this has got accelerators on wages every year of 2.5%, 2%. Is that going to happen every year? We'd love for it to happen. So build it into the forecast. We'd love to have a $250,000 every year for capital improvements. We built that in here. So please remember, this is not pie in the sky. Certainly we can come
Kinda.
up with more, but yeah, there's some cream in here.
Yeah.
But it's
Mhm.
what Isabella County wants to be,
Mhm.
right?
Right.
We want to take care of our buildings. We want to give raises. We want to attract. We want to retain. This is what it costs.
Mhm.
so we know we don't have a sustainable forecast 10 years down the, and I pointed out a couple maybe expenditure hits, but the one revenue hit is, and I think we have a meeting today to talk about,
We do.
is there a millage option out there to take care of this issue?
We do. We do. And this, to me, this is just proving out the need. This forecast. And
See, that's what we
I
got.
don't want to make it work. I don't want to bring you a nice rosy pink forecast that shows you something balanced magically in 5 years. That doesn't do any one of us any good. I want to give you a forecast that's realistic, and I want you to poke holes in it. I want you to poke holes in it. I want the department heads to poke holes. I want the accountant, I want Jessica to poke holes. Please, we need for this to be realistic and tight, right? If we're forgetting something, by God, let's get it built in. That's what this whole exercise has been.
Yeah, because you only have two options, increase revenues or reduce expenditures.
Mhm.
You've got, really only have 2 years, 3 years to do it. Just to figure it out, really got, that. If you think we only meet twice a month. For 3 years, it's 12 times 3. That's not very many.
No,
It's less than 100 meetings to get this figured out.
wow.
I mean, that's not very much
When you
time.
say it that way, no,
No.
it's not, but we're not looking at a 3-year forecast going, hey, guys, look, everything's rosy.
Right.
We can stick our heads in the sand and be fine next year. No. No.
Well, it does bring the reality up before everybody, so.
Mhm. That's important. It's important. I'm gonna stop my share, but I'm certainly open to any questions you might have.
So this was just a discussion item.
What's that? Yes,
Tobin's on his hand.
yes, he is
Want
still
the
on.
paper copies back or?
This will be something I guess. Melissa and I converse about too.
Use it to poke holes. Use it. Go home and poke holes in it.
I'm the worst case scenario, though. She knows that already. I want the worst possible scenario.
It means you gotta keep a tight rein on the budget as we move forward, doesn't it?
Yes,
Not too
Yeah.
much expansion and expenses, but
exactly.
until we know we have a solution to the
So there's some ideas. that we
fund
put on the
balance
table.
issue.
Yeah,
Okay,
okay.
the next item is the invoice list discussion. I didn't see a whole lot on either one of those that I had questions about.
Yeah, routine order of business.
Mhm.
Oh, RRS.
RRS is the consultants who performed the feasibility study on MRF.
Okay, that's right. Now I remember. That's good.
Would have been a progress billing, not the whole thing. So
3 to 7. Okay. Highfields.
Highfields is one of the placement agencies for the child care fund.
Mhm.
Do you have any questions or comments on any of the items presented?
Those were the only ones that I had.
It looks like you go down through the list too. I kind of look at those, but
We count on it.
when we have good department heads, elected officials, I think they do watch the spending.
They do. I know one thing, I wanted to talk about sage removal services.
Oh,
I know-
yes,
I know
I was
we
gonna
figured-
ask that.
Discrepancy, but you had noted that there were two very, very similar
Similar names.
invoices. Yeah, similar
Different
names.
first name initial,
Yes.
and I didn't catch that when I asked.
And
And
we,
he should-
so he basically contacted us to say, hey, is this a duplicate invoice? It wasn't, but it reminded me that I wanted to talk about what sage removal services is. It's a new, in addition to MMR. Now MMR is still our ambulance transport, so exclusive emergency ambulance transport service in the county. But one of the things that have been bogging them down, a problem that has been brought to me by the medical examiner and medical examiner's office and sheriff, is when there is a need for non-emergency transport. Sometimes our officers, sometimes our medical examiner investigators wait on scene for hours and hours and hours. While MMR is tending to live patients, right, as we want them to. So they've wanted to look for, they've wanted us to look for alternate means of transportation for the non-emergency transports. And this sage removal services has come up in the last few months. And we got them in touch with medical examiner's office, and they're thrilled. Sheriff is thrilled. Sheriff put out a new protocol, and we've brought them into the fold. So they're now doing some of those non-emergency transports.
And is this for indigent individuals?
Not
There's no
necessarily.
reimbursement?
It can be, but not necessarily. Anyone with a suspicious death goes to, the body's transported to the medical examiner's office, whether they're of a certain age, or they're young enough that they go, or just the circumstances around, needs to be investigated, they go. And I feel like Jessica's wanting to add, they need an autopsy.
Transportation for autopsy purposes. Yes,
Oh, okay.
so it's instructed by the medical examiner's office and investigation purposes, law enforcement, and autopsy.
So this has risen out of a need because MMR hasn't been able to provide timely transport. And so they working through Sage to provide that service.
And also, we've never had a backup transport to MMR. It just didn't exist. And so we're thrilled that this opportunity is there, and their rates are very agreeable to what MMR was
Where
charging.
they
us for
operate out
too.
of? Or
The Tri-City area, I believe. I want to say Bay City specifically.
I like the fact that we won't tie up MMR when they could be on an actual emergency run.
Right,
No.
yeah. Because at first, when I approached MMR with this option, I thought, oh, are they gonna be, they're gonna think that we're moving away? No, they're thrilled. This is something they've wanted to. So it is one of those win-win-win.
Yeah, to better,
Yeah.
provide better emergency service. Sure.
Mhm. And if you
Chris?
read my evaluation, well, that was one of my goals for this year, was to find an alternate backup transfer. So we're
I like it.
February, we're getting things checked off already.
well, good.
Yeah.
Yes.
Anything else? Then we'll just move these lists forward to the work session.
All right.
We're down to announcements. No announcements? We'll call to the public again.
Chairman Hope, was he?
Chairman Hope, are
Join
you on there? Do you want to make?
I am on here. Yes, I would like to, if you don't mind.
Before you start, good morning.
Good morning. Couple things. I think we did invite Commissioner Embry to our discussion this afternoon, didn't we?
I don't think so.
Oh, you're not in the millage. Oh, yes. Because I think you happened by the last one.
1:30.
Yeah,
I think you
yeah, that's where
happened
the-
in the room, and we were
You guys were
having,
looking for a bad guy. That's what I remember. Somebody to blame everything on.
what would you like to come back for that?
Oh, yeah, I got-
Blame blaming?
I got broad shoulders. I've
If
already.
you are available at 1:30 today, please join us, and
Upstairs.
Jessica, please add him to that email. Thank you, Chairman.
Yes, thank you,
Thank you.
Chairman.
Yeah, I think as part of the finance committee, I think we need him there. If he's able to make it,
Yes, I am.
but certainly in the future. We need to include him on those discussions. The 12-month report, that was kind of the good news that I needed to hear today, so that was
Mhm.
that was good. Commissioner Jelzinski, I liked your comment about the board and the administrator and the treasurer all kind of working together on these cash flow issues and other issues. So, and certainly that's been the goal of Nicole and myself, is to work with everyone. So, and I think that's happening. The other thing I want to mention, that 10-year forecast, I love the level of detail we're getting into with that. And to be able to break out the wages and benefits into defined contribution as opposed to defined benefit, and all that's very, very helpful in my mind. And we can see what's coming and plan for it. And I think that's crucial. And I appreciate that. I appreciate all the work you put into it, you and Melissa and probably other folks as well. So
Happy to.
Agreed.
that's all I have.
All right. If we have nothing else from the public, we'll adjourn this meeting at 11:30. We're getting a reputation for long meetings in this committee. Some pretty meaty stuff.
That's my fault.
Excellent.
I take the blame on that one too.
Have a great day, Chairman.
Yeah, we'll see you this afternoon.
Yes. that's
Likewise,
right.
yes, sir.
See you in a couple hours.
All right, thank you.